Okay, let's get started. So, though the structure in get exam ready, and it. So for these instructions, you can actually get used to them before the exam because this will be the same my instructions are only pure actually on the exam date. So there's no need yekuti because vachakupa time yekuti you can read through the instructions. So kana wawe versed with these instructions zvine zvakangofanana. And but don't think kuti ukakasika kuverenga my instructions there is any additional time, no. Was pandori 10 minutes dzekungoverenga for my instructions. And that is not part of your exam time. Zvekuti provided that per 10 minutes idzodzo waverenga my instructions ako in 2 minutes, it does not add to any time yawachazoshandisa muexam. So paunotanga first question, paunongoti start inotangidza afresh. So but zvinongokusevha kuti in the exam you don't need to exhaust your mind uida kuita go through all this because zvizhinji zvacho unenge wagara uchisangana nazvo. So using the platform actually helps you kuti ugare wava used to how the exam, how you respond to the actual system exam. So say the exam ready is structured into 3 sections. We have section A, section B, and section C. So for section A, always net in 15 questions. And each question will be carrying 2 marks. So that's a total of 30 marks. The same goes with, in my exams, A to A, we have section A, section B, and section C. And so section B, in my OT questions. My OT case questions, you are given a case, then after that case, my questions and relating to that given case. So for the OT questions, there are 3 cases. Each case in 5 more questions. So the questions will be relating to the case that you have been given. Then we get to section C. Section C in out of 40, and it is 2 constructed response questions. And you have to prepare, it could be the statement of, you could prepare the income statement, the cash flow statement. You can be required to prepare the consolidated accounts. So the section C questions, this is where you need also to work on your skills, especially typing skills and being able to present your information. Because for section C, you are not choosing, you are actually preparing it could be the income statement or the consolidated statement of financial position or anything of that note. So let's move on. So like in the exam, are you sure you are ready to begin the exam? And so paunoti yes, times there is a countdown from that. So times they do as the counter my instructions. Of course, for my instructions, they give you a maximum of about 10 minutes. So ukapedza those 10 minutes usati wapedza kuverenga inongokata yakuenda unotanga exam automatically. So for the section A, we have talked about the structure of section A. Now let's get to the questions. So which of the following is not? Please take note of this. Under exam pressure, you might not figure out kuti pakanzi not. Answer the first one. Which one is not? The first one didn't get to the correct one. So don't just be, please take note of these. Kazhinji vanonyora in caps or they can bold in it. Kuti ukwanise kunyatsoona kuti babo, what are we looking for? Which of the following is not a duty of the interpretations committee? So the interpretations committee, panogadzirwa international accounting standards. We have the board, we have the IASB. This is the board that actually sets the standards. So for the IASB, there are no gadzirama standards. Vagadzirama standards, the same structure to how even our local law system works. The law inogadzirwa through the legislative board. But paganzi ipo mutemo pamwe pane kana zvikanzi munhu atyora mutemo, you don't go to the parliament kwakagadzirwa mutemo kuti tione kuti munhu uyuyu atyora mutemo here kana kuti haana. So kana kuri kuti munhu akanzi iye zvaaita it's against the law, tinomuendesa to the judiciary, court. So what is the purpose of the judge? The judge is there to interpret, kuona kuti zvaitika nemunhu uyu iyi imhosva here kana kuti haisi mhosva. So the same goes with our standards. The one that sets the standards is the IASB, but the one who interprets the standards, kuti standard riri kumboti kudii, is the interpretations committee. So the purpose of the interpretations committee is to shed more light on what the standard is saying. So the interpretations committee, it helps to interpret what the standard is saying. So now looking at the answers that we are given, which one is not a role of interpreting? So in other words, which role can we say it's not a role of interpreting? Let me give you time to also try. Which one is not a role of interpreting? Yes, I also go with B, because the first one, to interpret, that's their role, to interpret. Then if we go to C, to provide guidance on financial reporting issues not specifically addressed, like the example I gave, judge. Judge anokwanisa kubatsira kuti is kana zvisina kunyatsonyorwa exactly in that manner. The judge anokwanisa kutaura kuti so can we say in this case this is right or this is wrong? So where it's not specifically addressed, they also help. So they can provide guidance where the standard is not specifically addressing what should be done. Then also they publish my exposure drafts for interpretation. So B is not a role associated with interpretation. Then for each of the following, identify whether or not the acquisition would be treated as a subsidiary or not. Lisa? Dance away. One password. No. All right, let's proceed. For the following, identify whether or not the accusation would be treated as a subsidiary of P company at 31 December 2017. Sorry, 20x7. So what's the criteria for recognizing a subsidiary? A subsidiary is a firm where we have controlling interest. Of course, in a subsidiary, we have control. And control is seen by what? Control is seen by having more than 50% shares, and control can also be seen by having the power to appoint the majority of the directors. So let's look at the cases given. The first one, from what we have been saying, what can we say about the first one? The acquisition of 60% of Z as equity shares on 1 March 20x7. Z's activities are significantly different from P Group's group of companies. So cannot C determine a subsidiary? We don't base on the nature of activities, but we are basing on control. So as long as we have control, we consolidate, not necessarily because we are doing the same type of business. So we don't disregard it as a subsidiary simply because our nature of business is different, but we consider control. So 60% gives us control. So we can say that's our subsidiary. Then what about the second one? I've done the first one. The second one is yours to try. What can you say about the next one. What can we say about the next one? Why? The offer to acquire. Mm-hmm. But the negotiations were completed. Yes. So the reason why we are not considering it as a subsidiary, it's not because of the party runs the offer, but it's because of when the conclusion was done. It was done post year, and it will be considered as a subsidiary in 20x8, not in 20x7. Please take note of the dates. So for FR, my dates are caution. Take note of the dates and never assume the year ends in December. The year can end in any month. So don't just assume that the financial year end is December. Don't assume the financial year end is December. Okay, let's move on. Let's move on. The acquisition of 45% of S company's equity share capital on 31 December 20x7. P is able to appoint 3 of 10 members of the board. What can we say about this one? Yes, it's not. Number one, control is less than 50%. Number two, even the appointing powers is 3 out of 10, it's 30%. So that one is an associate, not a subsidiary. On 1 January 20x6, Gardenbach's company received a 30,000 government grant relating to equipment which had cost 90,000 and had a useful life of 6 years. The grant was netted off against the cost of equipment. So if you're accounting for the grant, there are 2 approaches. So you can treat the grant as deferred income, or you can net off the grant against the capital cost. There's one. You can treat the grant as a deduction of the cost, or you can treat it as deferred income. So in this case, they are saying grant no deductor from the cost. Then on 1 January 2007, that's a year after, the equipment had a carrying amount of 50,000. Its use was changed so that it was no longer being used in accordance with the grant. This meant that the grant needed to be repaid in full by December 31. This year has not yet been done. So, is we receive a grant, but kana zvikanzi takutadza kumita ma-conditions, we have to repay the grant, which means it's now a liability to us. And this liability is to be paid within that same year. It's a current liability. So, so which journal entry is required to reflect the correct accounting treatment for the government grant and the equipment in the financial statements of G company for the year ending 31 December? And so if we want to account for the grant, so if we want to account for the grant that's being repaid, one thing for sure, we have said, since Tauta repay is now a liability, it's giving rise to a liability. And so the credit entry is a liability because now it has to be repaid. But let's go and look at the initial So what was the initial accounting treatment? So the initial accounting treatment was we had recorded a cost of, so we had the grant. So the cost of the grant. So the cost of the grant, not cost of the grant as such, the grant was for equipment and it's cost of equipment. So the cost of equipment had at 90,000. Then we deducted the grant from costs. So it means we had recorded a cost of, we had recorded a cost of 60,000. Then depreciation in the first year. Depreciation in the first year, 60 divided by, in the first year, depreciation is 60 divided by 6 years. And the use is expected to be for 6 years. And it was the carrying amount at the end of the year. The carrying amount at the end of the year is 50. So, which confirms what they said could be the equipment at the carrying amount of 50,000. But the problem now is the grant here has been de-recognized. It's now being de-recognized from our books, and we have to repay back. So if we have to repay back, it means cost yedu, it has to be revised. Our cost has to be revised back because now let me make the calculation just a moment here. 50. Okay, so it means if we are now accounting for this, it means for our grant, we have a liability of 30,000. Then in terms of our depreciation, the new depreciation expense, so double entry for the grant. So it's going to affect our equipment. It's going to affect our equipment. It will have an effect on depreciation account. It will also have an effect on the liability. So we credit the liability. So this one is an easier one, liability with 30,000. So we're crediting the liability with 30,000 that we need to repay. So the 30,000 that we have to repay, because now the grant is being taken away, we have to adjust the value of our equipment. So the value of our equipment should have been what? Provided we had not. So the equipment before the grant, it was supposed to be 90,000. Because remember, kana grant rakuti repay, treat as if charge tongori chikwereti chatatapiwa. Anditi? So isusu taifana kunge takarekoda equipment yedu at 90,000. Kana kuri kunzi takuita repay, treat as if it was a loan. So it means how much should have been the depreciation for the first year? How much should have been the depreciation for the first year divided by 6? 15,000. So 90,000 minus 15,000. 90,000 minus 15,000. So it means the depreciation should have been, what's the proper treatment there? Because depreciation here, Triguti carrying amount should have been 75. So 75 minus 50. So let me go back to the question. I want to read something. So on 1 January 20X6 revealed from that which journal entry is required to reflect the correct accounting treatment of the government grant and the equipment in the financial statements. So the depreciation expense with property, plant and equipment, depreciation expense, property, plant, depreciation. Okay, so it's all the entries are the same. It's just a matter of determining the correct amount. So for the depreciation expense, let's start with the depreciation expense. So for the depreciation expense yatakufana kurekoda now, takufana kurekoda 15,000. And the payabeta record the depreciation expense 10,000. But now, because the grant has been dishonored, now the depreciation expense is supposed to be, I'll just check this one, doubting it, but it means depreciation expense here to have fun out got 15,000. Then equipment, said we said the 15,000. So for this one, let's keep it on hold. I'll refer back to it again. I'm trying to understand the logic here. Kuti. Depreciation now, yeah, based on 90,000. Then, okay, let's move on. I'll get back to this. Okay, let's move to the next one. So the question is saying the following two issues relate to spy companies' mining activities. So issue one, Spico began operating a new mine on January 20X3 under 5-year government license, which required Spico to landscape the area after mining ceased at an estimated cost of 100,000. So we had not selected for the previous. So I think that was B. Let's move on. So issue one began operating a new mine in January 20X3 under a 5-year government license, which required Spico to landscape the area after mining ceased at an estimated cost of 100,000. So the costs that you are to incur at the end of the life of the asset, those ones are though admittedly cannot my dismantling cost, cannot my decommissioning cost. So you're supposed to create a provision for those costs. Kanakuruguti, it's an asset. You include them in the cost of the asset and you create a provision for the costs. And this one is a government requirement. So it's treated as we can say it's a legal obligation. And so kanapaine mari badara because of the law, then we have to account for them as a provision. So there's a legal obligation. So a provision can arise because of a legal obligation or contractual obligation. So in this case, there's a provision arising as a result of the law's requirement. And then we look at item number 2. During 20X4, mining activities caused environmental pollution on adjoining piece of government land. There is no legislation which requires Spico to rectify this damage. However, Spico does have a published environmental policy. Take note of that. Published environmental policy, which includes assurance that it will do so. The estimated cost of the rectification is 1 million. So in this case, there is no government obligation. We don't have a government obligation, but there is so an obligation can arise as a result of our policies secompany. And it kana tikati isusu ndo zvatakataura papolicy yedu kuti ndo zvatinoita anditi. So even the law isina kuti munofanira kuzviita because it's within your policy, maakutofoswa kunge muchicreate a provision. So in this case, I think both cases, they require the creation of a provision. Number one, a provision must be created if we can estimate the liability. In these two cases, we are given an estimate of how much you should pay. And also the first one, there is a legal obligation. The other one, there is the obligation is arising due to our organizational policies. So a provision is required for both cases. A provision is required for both cases. Then let's move on to this one. This one I'm sure you can try, Vega. Can you quickly try this one? How much should be the consolidated cost of sales? Let's quickly try that. Onyera munotarisira ndakapusa izvozvo. Asi zvirimo. Manudzi zvirimo. Siyoko pamanudzi amuna shivambori. Okay, what's your answer? Wow. Let's read together. Tell me what was the answer. 814. Okay. So Chikunzi so Parker Company acquired 60% of S on 1 January 2017. The following extracts have been taken from the individual statement of profit and loss for 31 March, for the end of 31 March 2087. So hopefully you considered the dates there because the period post accusation is just 3 months, January, February, March. So that's 3 months. So it means kuna subsidiary, my cost of sales. So for my cost of sales, not a parent in full, which is how much? Seven, 10,000. Then plus a subsidiary post accusation. So for sub duty, how many months after accusation? 3 out of 12 times how much were the subs for 80,000? Then the Vabazons, my cost of sales guy, you less intra-group sales. All right, come my intra-group sales of how much? Wakarenga zvakanaka. Erenga zvakare. Yes, 20,000 per month. So it means, and 20%, 20,000 is still in inventory. Markup is 25%. So it means the intra-group sales, it's 60,000 because it's 20,000 per month for 3 months. Then we add the PAP. So provision fund realized profit, totanga tati 20% kana 25% iri markup margin is 20%. Skatoti 20 times my sales are 60,000 times proportion goods in stock is 20,000 over 60,000. So don't go to 20 over 60, which is 20% times 60,000 times 20 over 60. Yes. Uh, 20 over 20 kwazi ngoiwanawo kwekuti inyaya yekuti 20 over 20 is more like hauna kumultiply any proportion wangotora 4,000 yakadai. Okay, let's move on. So it's 6,666. This one looks small. Yes, it's 480, not 48. Was 3 over 12 for 48,000. 774,000. Let's move on. A company has decided to change the depreciation method to better reflect the patterns of use of its equipment. Use the tokens to ensure the following statement correctly present this change, represents this change and how it should be applied. So, kana zvikanzi izvo tachinja the depreciation method. It's a change in what? Changing the depreciation method. Is it a change in policy or is it a change in accounting estimate? Yeah? And that's what I'm doing and do doing it. So depreciation method is a depreciation estimate. There's a change in estimate. Depreciation is an estimate. Then all changes in accounting estimate, they must be applied prospectively. So Notanga this year going onwards. Change in depreciation policy is in depreciation method. You apply it prospectively. You adjust from the current year going on. Included within the financials and the financial assets of Yahweh Ifris 9 included within the financial assets of Zenith Company at 31 March 20X9 are the following two recently purchased investments in publicly traded equity shares. So if we buy less than ukatarisa parunzi takatenga 10% and 10%, those ones, it's neither a subsidiary nor is it an associate. So it means you have to treat her in accordance with IFRS 9. So in this case, tinoita kunotarisa kuona kuti pane macases andakambokupai if you still have them. I can't talk about remembering them. You are to Chema. So investment one, 10% of the issued share capital. The shareholders, so this is an investment in financial instrument. And then the Batanza is also the shareholders, so the shareholdings was acquired as a long-term investment. So Timono Ndivuro Pamano's Ako AIFIS now. First case here, DJ. Pane investment, I gave you about 4 cases. Inoshandiswa kana zvaita sei at fair value through profit and loss. chimboerenga financial asset at fair value through OCI iri kunzi chii? Pazvakatangira. Mwana kunyora zvekusoro inofisiya. Ndizvozvo hazvo, but pane zvandiri kuona zvinenge zvisina kunyorwa. Let me, the good part about eh? Ndizvozvo zvandakatokudzai, but zvakashota. Ndakatione iri slide ring remuclass. Zvekuti so if it's 9 indeed. Fair value through profit and loss. Party and order for profit and loss. For the investment to be classified as financial instrument through profit and loss, the intention must be taken into account. If the intention is to keep the instrument for a short period of time, we classify as fair value through profit and loss, and the fair value through OCI. Sandakachitaura kuprasa zvinhu. Okay, so the fair value through OCI, this is used kana kuri kuti the instrument da kuichengeta for a long period of time. And so totenga my instruments aya, but with the aim yekumachengeta for a long period. Kana iri for a short period of time is the fair value through profit and loss. But kana toda kuchengeta for a long time, it's fair value through other comprehensive income. So can I read financial asset through other comprehensive income? This one is where we intend to hold to maturity, kana kuchengeta mashares aya for a long time. So let's go back to the question. And maybe it's certain a good question. Can I get fair value through profit and loss? Not what any fair value gains. And it to no mind it's a profit and loss, not to other comprehensive income. Gains or losses. But can I really fair value through OCI? The gains or losses are in this of OCI. So the treatment of my gains no inosiana. Kuti iye kuendesa my gains ku profit and loss, inga kuendesa to OCI. So now looking at the question now. Question yedu, it is centered on that issue yekuziya kuti, are we holding this for a long time or are we holding the instrument for a short time? So for investment one, Chiwerenga ukunzwisa kuti are we holding it for a long time or for a short period? So for the first one, Paragon's Ipo, as a long-term investment. So long-term zvinoreva yakareba naika munhu. If something is to be kept for a long term, it's for a long period of time. So if the investment is to be kept for a long term, we classify it as an investment at fair value through OCI. For a long term, it's fair value through OCI. So investment number two, what can we say about investment number two? One kuti iyo tati long term. Ndombokutorera foni. Short term azona vanhu. So yes, the intention is to hold them tozomatengesa ane more value. And so if the intention is you keep them for a short time, then you resell them. You buy my shares, uchida kuti akangogaina value ndomatengesa. You are keeping them for speculative purposes. And so if they can say it for short term, or they can talk about for speculative purposes. If you're holding my shares for speculative purposes, then go to gain a value of wamatengesa. And so in that case, if you are keeping them for speculative purposes, the gain in index of profit and loss. So for the first one, gain OCI, the other one, gain it went to income statement. So I think D, the first one, other comprehensive income, fair value through other comprehensive income, then the other one is fair value through profit and loss. You don't calculate to the right of use asset, the carrying amount of the right of use asset. Yes. But see, or the barese. Saka waichaka takaita sei. See, chingondisana nguroin brief, how do you get C? and the 8,000 rand ndakaisiya ndofabvisa kuti pezerota. Yes, we depreciate over the short term. Saka wakagesera zvawakaita chaizvaizvo hautonyatsoziva kuti saka wakanga wagesera. Always kana tiri kuefara, take notes of the dates. Chitarisa madates wochindudza zvawakaita. Carrying amount iri kubvunzwa pa is for the first. Okay, let's move on. So Transden, as a Transden company, operates an emerging market and with a fast growing economy where price. What is it? Downloads I want to open. To say you wakaisiya. All right, wakaisiya nyaya yekuti a maintenance cost is not part of the cost of the asset because it's a recurring cost. But as Avaronzi is going to be spread over the period of time. And so maintenance is not part of cost of the asset. But mama cost is anobhadhara ipapo kuti asset rivepo kana kuti tizonzitapiwa this lease, you include them. But maintenance is an expense. So which two of the following are true when using the historical cost compared to the current value? So historical cost to be reported, my assets. All right. So Tinenon's the historical cost accounting. The historical cost accounting, we record my assets at their original price. So we record the assets at their original price, where then the current cost tinenge record my assets at their current market value or replacement value. So you might record the cost, you might record the current value. So historical cost now, it's tend to be a bit unrealistic. Kana prices queen inflation because inoramba ichiratidza value yakare kare. which is not the current market value. So, but current cost, of course, the current market value, but the calculation manje, it means for every asset, pinda the asset, what is the current value of that asset in the market. Pamkana chambo shandiswa, it becomes difficult to find another comparator. In the market, so the question then is saying, uh, kana uchishandisa historical cost yekurekodha zvinhu neprice yakudhara. And which two of the following statements are true? Historical cost, capital employed, which is calculated using historical cost, is understated as compared to the current value. I think so, because the capital employed, remember, we are saying the total assets minus here, current liabilities, of which they transfer the cost you carry. So we end up understating the capital employed. So the first one, then historical cost profits are overstated if we compare with the current value profits. I think so. Why? Let's think of you selling chino and it. My prices akakwira pamwe pawakachitenga chaita $5 but now chaakuita $10. Iwe ukacompare selling price nemacost akare zvinopa impression yekuti uri kuita profit. So kana uine inflation iwe uchingoshandisa maprice akudhara aya, you'll be reporting higher profits than the current value, because current value inenge ichiadjustwa macost. So that one again is, I think it's true. Historical cost profits are overstated. Because tichishandisa cost yakudhara yanga iri, especially kana maprice ari kukwira, it means cost yedu yatinenge taakushandisa inenge iri pasi. Mhm. Uh-huh. Uh, that is very much possible. But read the first statement. Where prices. So kana kuri kuti the prices are falling is the opposite. But in this case, parunzi, where prices increase frequently. So my price edu arikutaura kuti maprice ari kuwedzera. Awa zvina kuipa kubvunza kuti ndokutunzisa. For this one, ungobona. All right, chiti joy. Iyi consolidation futi yawa. Ndozvawaiti ndozvawangosipedzisa kuerenga. Wakatoflega zvako. Tawa. Kuiflega hatirandi, but chakaoma nechipya. All right, let's do it together and see. So P acquired 80% of S on 1 October. So please always take note of the dates. So this is 1 October, and we are required to consider the 31 December. But can I take the statement of financial position? So uko kuna pa consolidator school apportion kunoitwa time apportionment income statement. And it so in this case so inventory on the date of acquisition, inventory had a fair value of 800, which is greater than the carrying amount of 600. So it was greater than the carrying amount by 200. Is it true? Because it was recorded in the 600, but EO in fact in the 800. So kana zvikanzi asset greater than the carrying amount, consolidator, unenge wakuadd that fair value adjustment. But in this case, pane statement rikuzotaura kumberi hanzi by December 20x5, 70% of this inventory had been sold. So chatiri kuedda inventory ichirimo warehouse. Hands of this kuratidza kuti inventory yanga iri in a fair value of 200 greater than the carrying amount. So tiri kuti isusu the fair value adjustment yanga iripo 200, but of the 200 zviri kunzi 70% inventory yakazotengeswa. Saka fair value adjustment yauri kunoedera is the remaining 30%. So what's 30% of 200,000? 60,000. So zviri kureva kuti inventory yanga ine fair value greater than carrying amount, but inventory yacho pakabva pazotengeswa imwe. So pane iripo izvozvi that inventory yanga ine fair value which is greater than carrying amount pangosara 60,000. So it means uri kuti parent plus subsidiary plus the 60,000. So fair value adjustment ikaita upwards tinoedera kuasset racho, ikaita downwards to subtract. But in this case why tisina kuedda yese is because imwe inventory yacho yakabva yatengeswa at the end of the year, of which what we are consolidating inventory yatinayo at the end of the year. Dai yese yanga iripo taingoedera parent plus subsidiary plus the fair value adjustment. But haisisipo yese iri ye200 kudaro 70% yakatengeswa pasara 30%. Yes, haimo because ivo vanga vakashandisa carrying amount ye600 irimo, but vanga vakairecorda at a lower carrying amount. Yes. Zvizikanwe kamwe zvine mazuva. Okay, let's move on. So the TT company has been trading for a number of years and is currently going through a period of expansion. An extract from the statement of cash flow for the year ended 31 December for TT is presented as follows. Which of the following statements is correct according to TT's statement of cash flow? So what can you deduce from the statement of cash flow at TT? Answer, the company has good working capital management. Working capital management is current assets, current liabilities, okay, net cash flow from financing activities have been used to fund. And the net cash flow generated from financing activities hatina kutogenerator pakatoita outflow mafinancing activities iyo haibude. Handeti ndandotaura b kuti b haiite pakuti vari kuti cash flow yatakagenerator from financing of which patoratidza kuti pakatoitika an outflow, then net cash flow from operating activities has been used to fund operating activities in a positive. Tikanoita fund 540. Yes, that can work. Existing non-current assets have been sold to cover the cost of additional. Existing non-current assets have been sold to cover the cost of the additions. Existing non-current have been sold. Dai pakatengeswa ma non-current assets, dai paine ma inflows, but pari kutoratidza kuti pane chi ma outflows. Indeed. Then going back to, so now we are left with A and C. A, the company is good working capital management. So working capital management is also the current assets less the current liabilities, of which working capital itori higher. It means we have more of current assets and less of current liabilities, of which isusu kana tiri pa cash flow. Kuwanda kwema current assets, it actually means imari isiri kupinda. Ichokwadi ma current assets akagaina, it mari isiri kupinda. So I think the correct answer is C, because yes, my operating activities can actually higher. It means but it means imari yanga ichitobuda. Kana kuti ne positive my operating activities, it means imari yanga ichitopinda, sorry, of which kana my current assets are high, mari inenge isingapindi. All right, C, drukutora C pakuti hanzi mari cash flow, net cash flow zviratidza kuti ndo mari yazosara yacho. Handiti? So zvinonzi net cash flow generated from operating activities has been used to fund additions. Handi muri kuona kuti pama additions pane outflow, imari yakabuda ka. Saka zvinonzi mari yatakabva nayo, because hatizviite kuti titore kunhu kwatobuda mari toti tatora mari ikoko. So operating activities kuratidza kuti kwakapinda mari. Sikazonzi mari iyoyo ndiyo yatakazonotora tikanofanda non-current assets. That's why uko kune positive. Why tati tatora mari because ndo kwagara kuratidza kuti kwakapinda mari. Kumwe kwese kuratidza kuti net amount kwakatobuda mari. Ko iyi mama vaona chii? NCI. So Rooney acquired 70% of the equity shares, share capital of Marek on its subsidiary on 1 January 2006. The fair value of NCI was 1.1 million. At that date, the fair value of net assets were equal to the carrying amount, except for a building which had a fair value of 1.5 above its carrying amount, and 30 years remaining useful life. Okay. During the year 31 December 2006, Mark sold goods to Rooney, giving rise to an unrealized profit in inventory of 550. Yeah, in any deal calculator takapiwa. At the end of the profit, at the end of the year, Mark's profit was 3.2. Okay. So we want to work out the value of NCI. So start with the fair value of NCI on acquisition. Fair value of NCI on acquisition. Fair value of NCI. Sikabva kushandisa chifoni yako iri kuita hai kuita ma-questions. Sikauri kupractice nei. Fair value of NCI. So fair value of NCI tadakatopiwa tutura at acquisition. Ndoyanzi was it 1.1? Eh? Fair value of NCI. Kana isina kupiwa unotora mashares atisina kutenga times the market price of farm. Let's say kana takatenga 20%. Subsidiary, let's say ane 200,000 shares and we acquired we bought 80%. So it means at Sina NCI, in terms of my shares, which is antitakatenga 80%. So at Sina kutenga is 20%. So unenge out 20% of 20% of 200,000. But 20% of 200,000 unaona atisina kutenga. Andeti wobva wazotiwewe times share price on the date of acquisition. Vanenge vakakupa isina kutopiwa, vanenge vakakupa the share price. Ndeti unenge wazoti times the share price. Or optionally, unogona kunge wakapiwa non-current assets. Kana shansa knows the partial goodwill method. Ndeti unenge wakapiwa non-current assets, unenge wakutiwa unoti net assets of subsidiary. Vakasakupa mashares, vongokupa net assets. Ungoti net assets of subsidiary. Times the percentage we have acquired. Percentage of NCI. So akudza kuti subsidiary anga ine net assets of 20,000. Isusu tikatenga 80%. So let's move on. It's got not fair value of NCI, but that share of NCI's profit. Sorry, it's NCI share of profit. Supposed to be NCI share of profit. So profit yaitwa na subsidiary, imwe share inoenda kuna NCI. Poitawo futi NCI share of reserves. So we have NCI share of profit and NCI share of reserves. So for NCI share of profit, how do we do it? Per NCI share of profit, notice isusu totanga tsvaga profit yesubsidiary. Mage. Hello. Tinofara makadiro. All right. Uniform tine list. So mune mako noti muda kutenga zvese ipapo here kana kuti mune zvamuda kutengawo kusite. So if possible mukandisira message ndokutumirai list rema prices emainforms edu. So munongochuza mune muchida pamwe muda kutenga ese pachikoro munongotenga kana muchida kutenga mamwe kunze. It's 20 per month. inenge iri 130 kana iri per 10 for mafees. 130 for fees. Yeterm inenge yangoregistra ne$5. Yes. Sorry? Yes. It's okay, Ndogo, to me upon bottom lesson. So once I'm done, look for whatever, if you can send a message, look to me. So let's move on. Sorry for the disturbance. Let's proceed. So NCI share of profit, tinotanga tatsvaga profit yesubsidiary. And it calculate the subsidiary profit. Also multiplier the percentage of NCI. We calculate the subsidiary's profit and multiply by the percentage of NCI. Okay, let's so tadakapiwa isusu kuti subsidiary aita profit yemari. That was the question, I think, is it 3.2 million? Confirm? So 3.2, but iri kuda kuadjustwa because funds ipo pa 3.2 pakazoitika pap. Kana tikatengeserana provision fund realized profit inobviswa kuside kwasubsidiary. Kana ari parent atengesa tobvisa kuna parent. Kana ari subsidiary tobvisa profit yasubsidiary. Andita. So in this case, pakatengeswa pakatika provision fund realized profit of how much? 550. Then chimwe chatinobvisa is depreciation on fair value adjustment. Tinobvisa depreciation on fair value adjustment. So two times asset transaction fair value adjustment. And it two times I wonder how much was the fair value adjustment. So it's a fair value adjustment. So per fair value adjustment, let's go and read the question. So Taranzi Susu, during the year, no, not that one. At that date, the fair value of Mark's net assets were equal to their carrying amount, except for a building which had a fair value of 1.5 million above the carrying amount. So we are told that there's a building with a fair value of 1.5 million above its carrying amount. So the fair value above the carrying amount is 1.5. Deja. Fair value above carrying amount is 1.5. Tawana 1.5. What is the next thing? We have to divide this 1.5 over the remaining useful life. So the idea behind is my buildings are undervalued by 1.5 million. But are undervalued by 1.5 million. But no value in my building, no depreciation, because Statica calculated depreciation using the value I record on my books. So pamawedzera, I'm going to add my assets here because pakupera gore, pamawedzera value my buildings, near depreciation calculated is supposed to be adjusted. So put 1.5. Data on 1.5 no fair value adjustment yet 1.5 million divided by is it 30 years remaining life. Tabona out so depreciation irufana kunge chiwedzerwa is 5,000 50,000 per year. But ngatarise kuti kubva patakatenga business iri gore rakwana here because 50,000 is for the year. How long is it post acquisition? How long is the post-acquisition period? Takatenga isusu 1 January. The year is ending when? December. So it's a full year. So if it's a full year, tringonisa yese yakakwana. If it was less than a year, would apportion. So tani adjusted profit ya subsidiary. Mm-hmm. Mm-hmm. Uh-huh. Yes, affect NCIC of profit. Tiny subtract for group retained earnings, no subtract for profit ya parent. So tawana 260 ndo profit ya subsidiary ta adjust. So share of profit takunoti 260 times the percentage ya NCI. NCI yanga inichi tatenga 70% and it tawisa 30%. Share of my reserves notice not my reserves aga gain here. Kubva patakatenga subsidiary pane gain here yakatika kuma reserves. Kana pakatika gain, that gain ndio multiply ne percentage ya NCI. So compare my reserves at acquisition and at reporting date. Kana pakatika gain, take that gain, you multiply by 30%. But in this case, we're not told anything about reserves. When a gain, oh, sorry, did we put the amount here? Yangaita chizia. It is of verify my answers. Ngaraji, 1 million. 1,178,000. Let's move on. When a gain on a bargain, purchase bargain. Purchase bargain, it means if there's a purchase bargain, just a moment. Okay, let's move. Now, the purchase bargain, it's not a way. For purchase bargain, not all takatenga isusu my assets are any price to less than the fair value. So business rako watoritengesa, iwo my assets are on the 20,000, but you marking ndikuona kuti ndiri kutumira ningiri inga ndava kutumira zvose wani paya asi Foni yako haina moto here kana? Apa ndiri mulesson manje. I can't type down zvese maningi nenda kuzokutumira ndapedza. Iwe hauri wega, hauna anyone here. It's fine. You can do the paida maybe I did type my price acho. Lisa. Tumirawo kamaprices aya but wototya kutaipa wotaipira maki and foni yake ine kunyadzima saka pane client ida kuziva maprices aingada kuziva kutomutaipira patext check. So let's proceed. So when again on purchase bargain, I was saying what take away the business at a price which is actually lower than the fair value of the net assets. So to put this with business, remember assets at 40,000, but I think it's maybe at 35,000. You have actually benefited. You have made a profit. So the question is then saying, use the tokens to ensure that the following statements correctly describe. Definition. This is when you acquire the assets, the business at a price less than. Oh. You are kutangidza. So purchase bargain is when a business is acquired at a price below the value of net assets. This can be because the business was suffering bad reputation in the market. This can be because the business was suffering bad reputation in the market. In bracket, purchase bargain is negative good. So kunewo kutenga, it's a benefit because what you think is from assets are at a price below, and it's not an asset, but it's a profit to you. You have bought something at a lower price. We treat it as a profit, and so purchase bargain is treated as a profit. So profit, when goodwill is negative, it should be because it's a profit in a credit balance. So we credit. Because find words that are profit here, we credit. To what? It is credited to the profit and loss. Okay, let's move on. On 1 October 20X5, Anita Company purchased 75,000 of Benita Company's 100,000 equity shares when Benita Company's retained earnings amounted to 90,000. On 30 September 20X7, extracts from the statement of financial position for the two companies were as follows. What is the total equity which should appear in the consolidated statement of financial position? Equity. Yeah, Yakapusabe. What is the total equity? That's around much. So we know can I talk to the issue? Can I share the statement of financial position? Financed by section. And it my shares tinongotora a parent only, but retained earnings ndo yatinenge takubatanidza parent plus subsidiary. And it so tikutora 125 plus combined retained earnings. Havanongoti equity shares, but equity tikubatanidza the shares plus the retained earnings. So tida kutarisa kuona kuti isusu patakatenga subsidiary anga aine equity ye90, now yapa 150. Saka taita tiri pamwe chete imari tikati 150 minus 90 tobva tazoti times the percentage of the parent. 150 minus 90 tinoona chi 90. So 60 ndo yataketa tiri pamwe chete tobva tati times percentage yedu 75 out of 100,000 it's 75%. Takatenga 75 out of 100. So the parent akatenga 75%. Ndo yatakunobatanidza neye-parent. Saka 45 ndo yatiri kutora from subsidiary tobatanidza neye-parent kuti wane group retained earnings. All right, so answer inozobudarichi. Got it. That's 125 plus 345. Therefore, okay, last question for section A. On 1 October 20X1, Bash Company borrowed 6 million for a long term, for a term of 1 year, exclusive to finance the construction of a new piece of production equipment. The interest rate on the 6% loan is payable on maturity. The construction commenced 1 November 20X1, but no construction took place between 1 December 20X1 and up to 31 January 20X2. When did we get the loan? 1 October, okay? Due to employees taking industrial action, the asset was available for use 30 September 20x2, having a construction cost of 6 million. So it means we used all the funds. So what is the carrying amount of the production equipment in Batch Company Statement of Financial Position as of 30 September? So the year is starting 1 October and is ending 30 September. So the carrying amount of the equipment, chekutanga tine 6 million yatakashandisa, and it's the cost. Then the finance cost tinoita kutesa kuona kuti per finance cost, what 6% of 6 million? 6% of 6 million is the finance cost for the whole year. 360,000. But how many your interest egorese? But no edera interest yaitwa during my months baba achitwa production. And it. So interest incurred. On November 20x1, but no construction took place between 1 December 20x1 to 31 January 20x2 due to employees taking industrial action. The asset was available for use 30 September 20x2, having a construction cost of 6 million. So to go to construction, yatanga 1 November, and it's November, but December tavatambo mira and it. Oh, yeah. One more. Yeah, but you can primary way to the test of it. We end up chat right. Inform I think investments, but to me, I enjoy primary. So to the production item nga. What's the Right, so production yakatanga November. Skatut November, then tojamba December and January, then February, March, April, May, June, July, August, September. So tango is 2 months yet. So it's 8 months. Not 2 months. Tabisa 4 months. Tabisa October. Tabisa October watch and it. Tabisa December, January. So tabisa 3 months. Was the no peraji was available by 30 September. So it means it's 9 months. Was about 12 months tango visa October, December, and January. Like it would no capitalize the interest yet during the construction period. Yeah, that's the because at goods or the construction yakapera rini. So the assumption is pachakanzi cha available for use ndo pachacha pera.